even with the geopolitical stuff and the higher gasoline price, which in the past would have pushed an economy into recession, the economy is booming. So which will tell you, in the absence of this Iran war, how much more booming it would have been. Because in a bubble, everything goes up, right? Regardless of whether you're good or bad. But the moment that markets is able to differentiate tells you that this price action is, when I looked at CapEx cycle, I found that they tend to last about 3 years on the way up and 3 years on the way down. And right now we are in the very beginning of a new one.
Is this the mother of all market bubbles happening right now, or are stock markets justified in hitting new all-time highs on a nearly daily basis? We're going to find out with our next guest, Anna Wong, chief U.S. economist at Bloomberg Economics. Now, you'll notice that my setup and background are different, and that's because I'm currently traveling, but I'm still very excited to be bringing you this very important economic update episode while I'm on the road. Back in October last year on my show, Anna had called for a V-shaped economic recovery in 2026. And so we're going to be getting an update to that call, as well as an explanation as to why markets are euphoric right now, despite higher inflation and a more hawkish Fed. And what will the Federal Reserve do next, now that Kevin Warsh is confirmed as the next Fed chair? This video is sponsored by Kalshi, the largest prediction market in the United States. Unlike a sportsbook, you're trading peer-to-peer on real-world events, from economic data to political outcomes, and the price moves based on public opinion, not a house. Go to the link in the description down below or scan the QR code here and use my code LIN, L-I-N. New users will get $10 when they trade $10. And right now, traders are predicting that there's a 72% chance of headline CPI inflation hitting above 4.2% in May. So, if you're willing to put $50 down on the odds of inflation going above 4.3%, your $50 may yield a $129 payoff. We'll also get Anna's take on this inflation outlook today. Anna, welcome back to the show. It's good to see you.
Thank you for having me again.
Back in October on my show, you called for a V-shaped recovery. Now, the economy is to be firing on all cylinders at some point in 2026, was the conversation that we had. Q1 GDP printed 2.0%. Consumer sentiment is at a record low of 48.2. This is according to the Michigan University Sentiment Index. Walmart, for example, just held guidance flat after Q1 beat, citing fuel costs. We know that Spirit Airlines just filed for bankruptcy, and the 30-year hit a 19-year high of just under 5.2% this week. All of that on the back of an inflation print that's the highest it's been since 3 years ago. How would you characterize economic growth so far in Q1? The numbers I've cited, some would say, are not great, although the stock market's at all-time highs. So I wonder if this V-shaped recovery is currently in progress, shown in other ways, or maybe you think it's just delayed.
Hi. So yes, I think the V-shaped economy recovery and the bullish view that we have come into the year with is actually largely intact. So the second quarter GDP now, tracker by the Atlanta Fed, is now reading 4.3% for the second quarter. And now when you think about that this is all happening in the context of surging gasoline prices, which nobody expected coming into this year. And even as gasoline prices are surging, recession is nowhere in sight. It's pretty stunning. So I would say right now, even with the geopolitical stuff and with the higher gasoline price, which in the past would have pushed an economy into recession, the economy is booming. So which will tell you, in the absence of this Iran war, how much more booming it would have been. So a lot of the forces we have seen, we have identified late last year as the to-be drivers for growth this year are still happening. The AI boom, CapEx from hyperscalers. After this earnings season, that CapEx has been revised up. In fact, I would say the takeaway from this earnings season is that this AI boom has even more legs to go. And already the sentiment for AI boom is already more subdued and less, less bubbly than late last year. But it's still going despite that more cautious pricing and trading behavior of investors, which tells you that this thing has really legs to go. So that's one component. The AI is still accelerating on a nonlinear trajectory. Then you have tariff uncertainty receding. So the Supreme Court has ruled that the IEEPA tariffs are illegal, and as a result, the refund we have estimated that there could be up to 170 billion in refund, and already 35 billion has been dispersed, and so we are forecasting that about 100 billion will be dispersed this year. So now that adds 0.3 percentage point of growth impulse to the economy. Think of that as a lump sum injection of money. So it's another form of fiscal impulse. So when we came into this year on the positive side of growth impulse, we have identified the one big beautiful bill, which would add 0.4 percentage point to growth. That proceeded as expected. So the tax refund so far this year has offset the higher gasoline price. That runway from tax refund should be able to cover the higher gasoline price until September in our estimate. So up to September, it means that the economy have both the one big beautiful bill tax refund and the tariff refund as a tailwind, pushing both investment and supporting consumption. Then after September, where the new fiscal year begins, there is another massive growth impulse, and that is from the defense sector. So the war has really depleted the weapons, the ammunition stockpile, and the U.S. government needs to build up that inventory again. It's a multi-year process. It's not like a one-year thing. And when you look at the defense budget in a budget over the last 40 years, once you start increasing the defense budget, it's a multi-year thing. It does not just increase 1 year. It just keeps increasing. So now Trump is pushing for $1.5 trillion of defense. This is compared to the 900 billion baseline before the war. This is 600 billion addition, which is about 1.8 percentage point extra impulse on the economy. It's stunning, David, that if we got that 1.5 trillion defense budget that Trump wanted, it would be a massive positive demand shock to the economy. Now, granted, it looks like the chance of a 1.5 trillion defense budget is unlikely because it really is too large. The economy also does not have the production capacity, nor the rest of the world, because manufacturing for the defense sector is very energy intensive, and the rest of the world is dealing with an energy shortage. The only place in this world which has a lot of energy right now, excess LNG, is the U.S. So much of this manufacturing boost would be domestic, is my expectation, and so I think that we would be looking at it. I think our baseline for the defense budget is it will increase by another at least 200 billion, so it will be a 1.1 trillion budget. That will add 0.6 percentage point to growth impulse heading into the new fiscal year after September 2026. So all in all, I still see growth maintaining at above 2% this year, very close to the baseline and the Fed's baseline. And the Fed already tells you what they will do under this situation. If growth is exceeding 2% and inflation is surprising on the high side, I think they came into the year with inflation core PCE falling to mid twos or 2.5 or 2.6 at the end of this year. And now it looks like it will be closer to 3 or even slightly higher than 3%. And so in this case, the Fed will find, even under Kevin Warsh, who wants to cut, will find it very hard to cut. So, so that's the gist of the growth picture. Just based on growth alone, it is not weak enough to justify for Kevin Warsh to find evidence to cut.
Right. Let's talk about inflation and economic growth in a bit more detail. This is from Cowsheep Prediction Market. Traders are predicting that by the end of May, the CPI for the next month will be 4.3%, above 4.2%. So high chance that it will be above 4.2%. It was 3.8 already at a multi-year high. At the same time, though, traders are predicting that the chance of a recession is pretty low at 15.9% this year. It's come down significantly. I'm wondering, Anna, why is it that inflation expectations are growing, but expectations for an economic slowdown are diminishing? Recall that in 2020, when there was a massive supply shock as a result of the pandemic, inflation shot up to 9% shortly after, and demand destruction happened after that, and we had an economic slowdown. Why won't demand destruction happen this time from higher inflation?
Because, so first of all, I think Wall Street has very well priced in a peak inflation for May. So what you have shown here is the May CPI print. And if you look at the fixing, it's pricing in a declining, disinflating year over year. So markets think that May is the peak. We also have been saying that May is the peak. So inflation will be falling. And so I think there's still largely an element of the forecast that this wave we're seeing from the war is transitory. And that's why, that's number one. Number two is the Fed. In 2022, the Fed were hiking in, recall, 75 bips increment multiple times. That was one of the fastest hiking cycle since the 1980s. And so, and so it was clear then, and also from history, most recessions, there are two reasons for recessions: oil price and the Fed. The Fed has rarely, right? So right now we have the oil price, and the oil price shock was unable to bring the economy into recession. This is highly unusual historically. On the Fed, the market has barely priced in any serious hiking cycle just yet. So if you look at the Fed's futures, as I've shown on screen on the terminal right now, the market has priced in almost a full 25 bip hike in January 2027. But this hiking, the Fed rarely hikes one and just stops, right? And this is a very rare, weird looking hiking cycle that the market has priced in, a very mild and tepid one, with one hike in January and just all the way till September, barely another 50% chance of another 25 bip hike. Very tepid, nowhere near the one that you saw in 2022. So I think the market is still not very convinced that the Fed is going to hike into this thing. Mm-hmm. And this is why markets are still going up. Because if the market is more fearful about the Fed, we wouldn't be seeing the rally that we are seeing in the stocks right now.
Okay. My final question to you before we close off is the markets at one point early on in the beginning of the Iran war, which is late February, early March, some would say the markets did reprice for a slowdown, or at least a shock to demand. And at some point, the markets must have reversed course, and now we're at all-time highs. What's changed investors' minds? Any
assumptions that initially the markets have made that did not turn out to be correct. Therefore, we had a V-shaped recovery in the markets post-March, I would say.
Yeah. Yeah, great question. I think two things. One is this recession and Iran war. When the war broke out, everybody thought recession is around the corner. And recession probability increase, right? And that so every time oil price goes up, the market goes down because of that fear.
Right.
And that turned out to be not the case because the economy is actually very, very strong. And consumption, despite sentiments being low, the consumption has been supported by the One Big Beautiful Bill. So basically, exactly as we were forecasting, all these positive tailwind coming into this year so strong that even a massive oil shock, one of the largest oil shock, was unable to bring down the economy. That's number one. So number two is this earnings season. So back in March, recall that there was a viral piece by a Wall Street analyst by the name of Cicchini, who was who wrote a piece about how AI could bring down the economy, just a thought piece, right, to get people thinking. And I think that really triggered some fear that people have in their mind. However, as the earnings seasons start coming in, one thing that fundamentally assured this AI trade is the demand is just outpacing supply. And you can talk about a bubble when you see demand lagging behind supply, and there's excess capacity, and all these investment are going to stuff that is not being utilized. That is a bubble. But in this earnings season, you saw from Google that AI-related products grew 800%. That's ridiculous. Intel, why is Intel surging? Everything, all the orders are full. Even Intel CPU are all full. So one after another, you see that the demand for this thing is so strong that there's so much more one way to go. And the market is also now increasingly able to differentiate between the successful hyperscaler and the hyperscalers who are probably over investing. And once you see this differentiation in the market, it tells you that the market is being rational. Because in a bubble, everything goes up, right? Regardless of whether you're good at that. But the moment that markets is able to differentiate, tells you that this price action is actually justified. And we are also seeing earnings increase. So with Google, for example, the margins are increasing even as they increase CapEx, which is very reassuring about how long this CapEx cycle has to go. And from a macro perspective, I will say that when I look at CapEx cycle, I found that they tend to last about 3 years on the way up and 3 years on the way down. And right now we are in the very beginning of a new one. I actually see this CapEx cycle having at least another 1 or 2 years to go, considering last year is the first year. So I think the earnings season really was very reassuring and sort of dispelled the notion that we are in an AI bubble right now.
Okay, excellent. Anna, I thank you for your time. Really appreciate your insights. Tell us where we can find your work.
You can find my work on the terminal if you have a terminal account at Beco, go, BECA, go. You can also find me on Twitter. My handle is at Anna Economist.
Okay, we'll put the links down below. Well, the link for Anna's handle. So please do follow her on X and, of course, the Bloomberg terminal if you have it. Thank you again, Anna. Have a great day, and we'll see you next time.
Thank you, David. Have a good vacation.
And thanks for watching. Don't forget to like and subscribe. Follow Anna in the link down below on her social media. And don't forget to use my code LIN, L-I-N, when you sign up to Kalshi. Link down below in the description or scan the QR code here. And remember, new users who use my code LIN, L-I-N, will get $10 when you trade $10.